Welcome everyone to the channel. In this video, I'm going to talk about how to spot a fake order block. So before I begin, I am not explaining this from the perspective of ICT. So if you want to learn about order blocks from the way that it's taught by ICT, please go to my description. You will find a link to a video that talks about order blocks from ICT. Now that's out of the way. What I'm going to explain is the three criteria that I use to identify an order block. I'm showing you gold, historical prices, and I'm on the monthly chart. The reason is simply because it's easier to spot an order block from a monthly time frame than it is from a weekly or even a daily. Yes, the lower time frame simply represents price action within the existing block, but it's much easier to show. So right here, we have an order block. Now, the reason it's an order block is because of these three criteria. The first thing, which you can't actually see on this chart because I don't have the historical volumes, is that it will have high or very high volume. This represents activity within that specific block or candle. If you do have ultra high volume, then it's most likely not an order block, just simply because when you see ultra high volume, it's typically manipulation. However, high or very high volume is indicative of activity within that particular block, in this case, a candle. So before I continue to the second criteria, it's worth saying that the order block or the candle that is the order block is the last candle in the trend. So in this example, the trend is going down. So the very last candle in that trend is your order block. The second criteria for the order block is that it will reverse prices. As you can see, this order block reverses prices in the opposite direction, that it is job. So imagine that there has been a lot of activity. Think of these as buying or selling, and the smart money wins. And what do? They simply reverse prices. That's the job of the order block. So now we have criteria one and criteria two. The third one is actually the most important criteria of the lot. And that is because the third criteria is that the order block will defend prices. Think of this from a smart money perspective. If I've just spent all this time accumulating this particular security, then I might as well defend that level. So in this example, you can see that this price that goes up comes back down and is defended right at the top of the order block. Sometimes this defense will happen in the midpoint of the order block, but that tends to tell you that the order block might be a little weak. Once that happens, then expect prices to move in the direction that the smart money wants to move prices. So that's it in a nutshell. It's these three criteria that make up the order block. If any of these conditions or criteria are missing, then it's simply not an order block. That is basically how you spot a fake order block. The simplest way to understand it is that if prices are not being defended, then it's not an order block. So as traders, what we have to do is we have to anticipate what is likely to happen. I do this by understanding that if I'm at a major swing point, like a major one, then it's likely that there will be an order block at that level. So we anticipate prices being defended at that level. Yes, you could be wrong if you read the bias wrong, but like I said, for you to determine that it is an order block, those three criteria must be met. So hopefully you got some insight from this video. Please like and subscribe to my channel. Thank you for watching, and I'll see you in the next video.